Hey guys, Scott Short here with Empire Home Loan Corporation. My MLS number is 225-998. My DRE number is 0107-4493. I can think of that one. Here, my buddy here.
All right, Raoul Badde with PennyMac,
So
Senior
Raoul,
Account Executive at CMB.
so Raoul has been around for, how long have you been around, brother?
22 years.
22 years. So I've always appreciated Raoul. I see him on LinkedIn, see him everywhere. He's always been a constant professional. He knows what he's talking about. A lot of people don't know what he's talking about, so that's why we have him online here today. One thing we want to talk about is giving consumers timelines. What's going on? Let them know the truth, what's going on. And then let's talk about some other pieces behind that. But what you were saying to me, we were talking about earlier before we got on camera, that you have some people you know who do a lot of loans. The reason they can do that, how's that happen?
So it's really just a function of setting expectations and allowing the loan officer to clarify to the borrower what it's going to look like to go through the mortgage process, what that life cycle looks like start to finish. Handing off documentation up front, something that they have as a takeaway as a consumer, so that they have confidence in that originator's practice and abilities, understanding, most consumers have already found that originator through online resources. They might have already made a decision to buy from that, or at least give that individual the opportunity to sell to them, or to buy from them. And so now they just want to understand what's it going to take to get from the beginning to the end in that loan cycle, and what are the different milestones. So if you're an originator and creating that clarity to the consumer at the very beginning in that very first conversation and having that confidence, you'll actually start to get additional buy-in from that consumer, because they will imagine themselves going through that roadmap with you. I mean, ultimately, that's what we all want as originators, right? Is we want our borrowers to follow along with us, kumbaya to the end, and we all close successfully, right? And so whether it's a 14-day closing, or it's a 21-day, or it's some contingency set with a 45-day, explaining that all to the very beginning, and even giving them something tangible, a document that explains that in a printed format, is, I think, often overlooked in our world, especially on the originator side, and it creates so much more confidence for the consumer in what to expect next.
Yep.
So then you get that consumer to assist you in getting to the next milestone. Essentially, the consumer becomes your they become the co-owner,
right,
to helping meet those next milestones earlier in the process, allowing you as an originator to have even more success, because you don't have to now call that consumer back and say, hey, oh, by the way, it was
One more thing. Right?
Yeah, we don't need one more thing, because they've already one more thing to you
Yep.
up front, and that is, they become your junior LOA to a degree, and they start, bird dogging you and being like, hey, I gave you this, can you give me here, and stuff like that. Right. So I've seen that happen in a number of different business practices out there, and all of those originators are closing north of 200 units a year in and year out. So if you take the time to implement it, you will find additional success. Right. It's a slow road initially, but it starts to compound itself.
Let's give an example. You did your own personal jumbo loan.
Yeah.
And you said you appreciated that the loan officer who did your jumbo loan because they gave you time. Like, can you walk me through what they said to you?
So they just wouldn't, they pre-qualified me in that initial transaction, and so I knew who the originator was, and I had selected them myself, and called them, and between, their competitive offering in terms of the product, what I needed, their understanding of the guideline and that initial breakdown and review, because there was a nuance that we needed to address, and then her confidence to me in terms of, knowing if I provided and supplied sufficient documentation based on the conversation. But the best part about it was, of course, I'm in the loan business, so I'm trying to hurry it up, right? Come on. And the best part was, for me, was she forced me into a bucketing system. I couldn't move my own loan forward as her consumer or her borrower until I met these minimum thresholds. But those same minimum thresholds meant that when they came back through the closing or the conditioning underwrite, that I had fewer conditions, and fewer question marks around my ultimate clear to close, my ultimate loan eligibility. So that's what was so valuable about that, because it eliminated what can happen in the process if we don't have those variable comp year-end pay stubs or BOEs in file up front, or 2 months bank statements and things like that, where we know all the source assets. like all the question marks that can come up in an underwrite were eliminated by this mandatory submission process that I had to follow as a consumer. And it also made me hurry my process up too. Like I was like, well, I'm in a 21-day escrow. I need to get this, and that's where I was saying that, the borrower becomes a bit of your own LOA because they realize they're under a time constraint and they now have to hit these minimums in order to eliminate the time constraint. And they become your assistant that way and helping you create your own success. So
would you say that processing, I'm not moving you, child, give me stuff, made you urgency, understood what you had to get there, and helped her do the job fast for you?
it allowed her to, it created urgency for me as her borrower, and it allowed her to create more quality of the process overall, so that when we came back through, I had to deliver it, whatever it was. The documentation on my EMD, an additional updated pay stub most likely, and whatever, one other thing at the time.
Right.
But it was from my perspective, I had 2 or 3 items that I had to deliver to her. The rest were appraisal, title, and insurance related things that are,
Boom, done.
yeah, those are just third party things standard to every transaction, right?
So the bottom line is for all our people that are watching this, make sure launcher tells you timelines up front, what's going to happen. Get them stuff as soon as you can. Don't give them half-baked stuff. Don't give them stuff from last year, last decade. That's just wasted time. So be proficient. We can make our job better, simpler. We've both been around the industry for many decades. So we're trying to help you guys help yourself out. So loan officers also make sure you call that line. Let your clients know that line's being important line because it helps process faster. It gives you better rates. Because if I send you a loan that blows up later, that's not good, is it?
Again, not having unknowns in my life cycle create uncertainty, which then pervades itself back into the conversation. The originator's talking to consumer and be like, well, now I've got uncertainty about this and this and this, and I need this. And so this is where, your loan officer is your partner in success for all of this, right? So you want your originator, you want to overshare with your originator, right? Because the more that they know up front, the more that they will be able to prepare you for the expectation, and they'll be able to hopefully set expectations around documentation requirements, and even in our conversation, require those before the loan even moves forward. Not allowing the loan to move forward with that documentation is the best move, I think, for anybody, because then the originator can actually find the best available product at the lowest available cost in the marketplace out there. And that's why we work with loan officers as consumers. We want our loan officers to go bird dog that next deal, that next best thing. So if I'm a consumer, if I'm a borrower, what do I need to do to do that? Right? And really that's the take.
I'll tell Raoul that, funny thing is that my joke is this: you think CIA has ways to find things out? Underwriters like that, a whole other system blows CIA away. So these guys find things out that just basically, like you said, be very honest and transparent with your loan officer, make sure they know what's going on, because you'll be found out. I mean, it's almost,
We have access to all the available public record tools and all the available data tools that are out there. So absolutely, and we will, as a requirement of saleability prior to closing, continuously update your credit. So we won't pull a new credit report, but we will monitor for new transaction or new credit lines that have been originated all the way through the note date, because that is a requirement for us. If we're packaging the loan to be able to sell it, we have to place our own certification on that loan that all the debts that we addressed in the credit risk underwrite and the debt to income ratio that we have signed off on is actually representative of the consumer's credit exposure in the marketplace. So that's why we have to continuously monitor for new credit lines being originated, whether it's car loans or they went to the furniture store or whatnot, but we're going to find that stuff out at that point. And we're going to know it before we get to the note date.
And what he's saying right there, underwriting is going to be a very short window, because you're the ones that think done fast. When you got guys doing compliance stuff or investigating you guys, they got forever to research and drive you guys. Right?
They get many years to do their
So it's
review.
not that short window.
They're looking at all of our originations and all of our practices, absolutely, and take a very holistic approach to how we're ensuring loan quality and saleability to the agencies for
And
sure.
you told me that as a lender, you have 3 years on the hook. How's that work with 3 years on the hook with Fannie and Freddie?
So with Fannie and Freddie specifically, they're looking at us when we originate a loan file for that consumer to make payments for 3 years continuously, so we get a little bit of leniency if that consumer's made 36 months of payments, and after 36, we don't get ultimate leniency, but we get a little bit more leniency after 36 months of payments have been made by a consumer, documented, because then. The industry has made it, and the industry has made a determination that look, economic events happen to everybody.
Yeah.
Then they're out of our control, right? But have we put in place the protections up front in our thought process of creating that loan file that consumer will continue to pay for 3 years forward, right? And so that's part of how we're managing up at the very beginning in your transaction when it comes through. That's how we are managing the credit risk.
And that's what the government actually says, as long as we get good loans coming through a pipeline, we're good. We'll give you best pricing. But you start seeing early stuff happening, they gotta start getting a little more, like, what the heck, bro? Not saying you guys only, but saying as an
overall, yes, loan quality matters. And there is no excuse for lack of loan quality in today's market. So, in the past, there might have been pricing mechanisms and things like that. Most of that is determined actually by lock pull through.
Right.
So, it comes to us as a credit provider to be able to.
Let's trash it real quick. So, lock pull through means that when I lock a loan with my buddy here, Raoul, sorry, where your Hans from? Raoul, sorry. Cougar man. So I like a loan to have. If I don't deliver to him, that's a problem because they're losing money there. But if I do it too many times, he's gonna cut me off because keep breaking down how people. Because a lot of people want to lock in one lender and shop around, find some lender better. How does it hurt the first person locking in with you?
So when you're locking with a lender, as a lender, we're going out and hedging that lock. We're essentially buying the same dollars in loan amount in the open market to get a rate of return to offset the cost of the lock, right? So if you lock for 30 days and you're getting a point credit, let's just say a lender credit, we're going out and it's a $500,000 loan. We're going out and hedging $500,000 to pay us incremental 1 point over that same time period. Broken down over a 360-day year and all that stuff. So that hedge is designed to.
It's not free, is it?
What's that?
Your hedge free?
The hedge is not free.
Okay,
No, the hedge is not free, and it does cost money, right? And we do that on purpose because we want to operate a profitable business. Because if we just went out and locked loans without hedging, and those locks didn't perform, we would then as the investor, we would have to forward those dollars for the commitment. The 1% of $500,000, a $5,000 check, we'd have to forward to the company that we had locked to the agency we'd locked that rate with. Well, if we do the hedge and we get our $5,000 offset, now we're getting and sometimes we can even hedge it a little bit of incremental benefit to our business, and so now we're getting a little bit of return against that $5,000. So we get our $5,000 back. We pay you, we give you $5,000 in credit, we get $5,000 back. So breaking locks can be expensive. At the same time, the industry has sort of built itself up to an expectation of pull-through. So most models today, I think, are set at in the 70 to 75% pull-through range. The expectation is that 1 in 4 loan locks are going to ultimately break for any number of reasons, whether it's, home price falling, in a purchase market, you've got the home contract not performing, the seller, the buyer, something, credit components. In a refinance, you've got market variables that happen, and it's hard to the market fluctuations, But all of that is then offset by this hedge process, so that there's not while there may be some losses, they're not exponential.
Right. Don't kill your company.
Yeah, right.
So let's do one question. Let's do one more question.
Sure.
Come my time up a bit. So we talk about if somebody refinances a loan within the first 6 months, then that's a problem to the lender who originates. So you break down for consumers that we're not trying to lock you into a deal, but we're saying here's the reality of what's going on. Can you break that down for people?
So, what Scotty's referring to are early payoffs, right? And so, all of your loan pricing is set by ultimately your ability as a consumer to continue making mortgage payments, and the expectation around you as a borrower continue to make those mortgage payments for a period of time. At a bare minimum, every note has has its core term of 300. So, but we, as an industry, we've made a determination that the average consumer keeps their mortgage loan for somewhere between 7 to 10 years based on loan size, right? Larger loan borrowers tend to keep their loan less frequently. Lower loan borrowers keep their loans longer. But nationally, the average is in that 7 to 10 year range. So that is a determination of the mortgage servicing value, and we get paid up front for delivering that mortgage servicing right to whomever it might be, whether it's ourselves or whether it's another investor out there. The marketplace has the marketplace has determined a cash value that gets paid up front for the originating of that loan. What has also come to light after all of this data gets extracted is that, if a consumer doesn't make mortgage payments for 180 days or 5 payments after closing, typically 5 to 6 months of payments, we like to say, we have significantly less value in that loan, and it starts to draw down on the aggregate value of mortgage servicing rights in general. So, every company out there has put in place what's called an EPO clause to their contract, whether it's a retail lender with an originator on the street in their office, or it's a loan officer at an independent mortgage brokerage originating a wholesale mortgage loan. There's a 180-day EPO clause where we have a right to claw back the commission that was earned on that transaction, to offset the losses around that mortgage refinancing earlier than 6 months. And we had to create some parameter, right? Because the market can move quickly and consumers can behave quickly. The industry set sort of a minimum bar of 180. And again, this is just like the hedge component. It's almost like a built-in hedge cost, right? Where I go, okay, well, if your borrower creates an underperforming loan for whatever reason, then I have an offset to my losses, because I have guaranteed when I sell that loan off, I have guaranteed that consumer is now going to go into your ecosystem and pay for a period of time, based on loan size, FICO score, LTV, all these different things. Like, the expectation is there. So I have to hedge essentially, and that's part of what the EPO process is. As a consumer, you now have some restrictions built in place against, if you're an FHA consumer, you can't refinance for 210 days.
And that's HUD's rule.
That's HUD, FHA. That's not a lender driven.
Right.
VA, 6 months, same rule, right?
Right.
FHA, cash out, 12 months of ownership required. Fannie Mae, cash out, 12 months of ownership required. So some of these concerns, it's now just rate and term loans that we're dealing on Fannie and Freddie that we're having to address, which, thank goodness, it's a smaller subset. It used to be a much larger component of the aggregate market. And then, of course, non-agency loans are susceptible to that. But since most of the non-agency, what we call like a jumbo or a non-QM, a very specialized loan product, since some of those terms and rates are so specialized, those consumers are also, interestingly, less likely to refinance because they might have got a better deal up front in the first place. Like, the fact that they even got that loan incentivizes them to pay longer over time, right? So that is how the EPO, that is the purpose of the EPO, and it is to create essentially a naturally operating mortgage market, so we don't create seizure, we don't get a lockup where no one wants to offer any money for a servicing right, and no one wants to then originate into a dead pool essentially. And so we have to be, what's the trade? And the trade is the EPO.
Right. And the thing we're saying here is that there's a lot of pieces behind this stuff. So a lot of things you guys don't understand, but we understand as lenders, that the mechanisms that are behind this thing, we gotta make sure we're safe. You can keep our entire industry safe, because if EPOs start going crazy, then you're gonna see rates not be happening because you can't sell,
Well, then the trade is what then the trade is a little bit of what we're seeing today in the mortgage marketplace, where everybody's betting that we're going to go into a refinance boom. And so actually many of the mortgage rates that we're experiencing today are marked up or over marked up, if you would, before they even get to the consumer. And they're done by the capital markets teams nationally. There's 7 fixed income trading desks, and they set the cost out there. And they've built in a markup, understanding that the majority of the loans that are being put into service today will most likely refinance within the next 18 months. And they're like, well, I want a risk offset. I want to trade on that. Like, if I'm going to give you $500,000, $200,000, $1 million on a mortgage loan up front, and I'm not going to get incremental interest repayments beyond 9 to 12 months, that's not valuable to me as an investor. So I'm going to mark it up before it even gets to the lender. This is outside of every lender. And the lenders are doing their honest to goodness best execution. They're delivering the lowest they can absolutely do today, everywhere they go. And Scotty's the cheapest because he's a mortgage broker. But they're doing their absolute best to deliver the lowest available cost to their consumer, but they're constrained by 4 levels above them in the capital markets. And again, back to the hedge, where the capital markets teams are going, we're just going to take some money off the table up front. It's going to go, the consumer's going to pay for it whether they like it or not, and they will either take it or they won't. And that's better than us originating a whole bunch of this product and potentially losing tens of hundreds of millions of dollars in 18 months, and then having to go back to everybody that we're trying to create returns for and explain how our strategies fail. And this is what we're subject to, right? Scotty and I are on the street. We're at the front of in the trench, and people looking at us like, well, hey man, why are your mortgage rates so high? It's like, and then the lender, and then so there's elements here that are completely out of our control, all of which are designed to mitigate risk and ultimately create long-term normalcy to how our markets operate.
And keep rates low. Keep rates low. Everybody plays
low enough, right? Like, so, and also what is low and all of this stuff. But that's a whole nother conversation for a different video. But my point is that we need capital markets to operate fluidly and feel comfortable extending essentially money credit for the purposes of mortgage lending, so that consumers can get and buy a house today, so that we can continue to, build on that wealth building concept of home ownership and being able to allow them and give homeowners the opportunity to grow their generational wealth over time. And so how do we do that?
See, that's awesome. This right here, you don't get this gold any day. This is phenomenal. So, as a loan broker, how do they get a hold of you?
So, loan officers can find me. I'm at Raoul Badde at PennyMac.com or 415-699-0980. You can find me on LinkedIn.
You spell last name for us.
Badde.
There you go. So
Badde.
You try to phonetically forget it, ain't happening. But I love Raoul, man. He's awesome. We appreciate his time. If you want to watch the industry, watch this guy here, what he does, because it's the truth. It's the success you need, not this Instagram clickbait, not the trash you see. He's a phenomenal person. If you're in LO, man, check him out. PennyMac, one thing on the good side where PennyMac is from a broker standpoint is that there's some great things as a broker versus being a retail person with PennyMac. So give Raoul a call because he's got some stuff to tell you that you probably didn't know. And there you go. Thank you, brother.
Appreciate it.
Bye.